This video is a review of Tokio Marine's financial results for the third quarter of fiscal year 2025, covering the period from April to September 2025. Tokio Marine, founded in 1879, is Japan's oldest insurance company and today a leading global insurance group. In the second quarter, adjusted net income made steady progress. Natural catastrophe losses were lower than expected, and rate increases in Japan's auto and fire insurance are now contributing steadily. The international business is performing well, supported by strong underwriting and reduced capital losses in North America. Overall progress toward the full-year plan has reached about half of the annual target, even when excluding business-related equity sales. However, the full-year projection without business-related equities has been revised slightly downward because of foreign exchange impacts, weaker profits in Asian life insurance due to lower interest rates, and higher advertising spending at Tokio Marine Direct. These negative factors offset the strong performance of major overseas subsidiaries. Shareholder returns are increasing in line with profit growth. The dividend per share for FY2025 is being raised by 1 yen to 211 yen, and the share buyback program is being expanded by 20 billion yen to a total of 240 billion yen. Net income progress has already reached 75%, partly thanks to the sale of business-related stocks, but it is unfortunate that Tokio Marine issued a downward revision for the full-year forecast. Tokio Marine's top line, premium revenue, is progressing for both Japan and international segments. In Japan, results are generally in line with the plan. Auto and fire insurance are benefiting from rate and product revisions, and a large volume of fire policy renewals is expected in the second half, so the company maintains its original forecast of 4% year-on-year growth. Domestic net premiums written grew 4% in the second quarter once foreign exchange effects are removed. Life insurance premiums in Japan temporarily declined because of block reinsurance transactions, but this was planned, and full-year life premiums are revised upward due to strong sales of a new product launched in September. International premiums were slightly below the original projection in the second quarter because some business lines softened, but overall growth remained supported by strong underwriting and rate increases from international subsidiaries. For the full year, international premium growth is revised to 4%, slightly lower than the initial 6% forecast, reflecting disciplined underwriting in softening markets. Overall, total net premiums written increased by 4% year-on-year on an FX-neutral basis, and the full-year outlook incorporates both the strong underwriting momentum and the adjustments needed where markets softened or where reinsurance arrangements affected top-line. Adjusted net income including business-related equity sales reached 755 billion yen, which represents 69% of the full-year projection. Excluding business-related equities, adjusted net income achieved 52% of the annual plan. The strong performance was driven by lower natural catastrophe losses, the positive impact of rate increases in Japan's property and casualty insurance business, strong underwriting in international subsidiaries, and a reduction in capital losses in North America. Japan property and casualty insurance reached 64% of its full-year forecast, supported by fewer natural disasters and higher investment income. Japan Life reached 70% of its plan, benefiting from lower-than-expected initial costs. The international business achieved about half of its yearly target, with solid underwriting offsetting the impact of the LA wildfires and foreign exchange losses. Tokio Marine is largely on track with full-year forecasts. Tokio Marine now expects adjusted net income excluding business-related equities to be 672 billion yen, which is 28 billion yen lower than the original plan. This downward revision is mainly due to foreign exchange losses between foreign currencies, a decline in profits in Asian life insurance caused by falling interest rates, and an increase in advertising expenses at Tokio Marine Direct to strengthen underwriting. These negative factors offset the otherwise strong underwriting performance of major international subsidiaries and the reduction in capital losses in North America. However, when business-related equity sales are included, adjusted net income is revised upward by 10 billion yen to 1.11 trillion yen because the company accelerated share sales earlier than planned. FY2025 dividend per share will be 211 yen, which is 39 yen increase from the previous year and 1 yen higher than originally planned. This marks the 14th consecutive year of dividend increases. Even though gains from business-related equity sales will no longer be counted in adjusted net income after the shift to IFRS, International Financial Reporting Standards accounting, Tokio Marine says it will still maintain dividend growth aligned with top-tier earnings growth by expanding the underlying earnings base used as the dividend source. Historically, dividends have been based on the 5-year average of adjusted net income. Beginning in FY2026, they will instead be based on the 3-year average of IFRS adjusted net income, reflecting the transition to the new accounting standard. When additional gains from the sale of business-related shares disappear, dividend payout ratio will appear very high. But since a progressive dividend policy has been announced, a dividend cut does not seem likely in the near term. Tokio Marine's capital position is strong, with an ESR economic solvency ratio of 155% as of September 30, 2025, well within its target range. Reflecting this, Tokio Marine increased its FY2025 share buyback plan to 240 billion yen, up 20 billion yen from the original plan. In addition, Tokio Marine will repurchase its shares through a TOB to support shareholder returns and capital management. The buyback is capped at 130 billion yen. Major participants include Mitsubishi UFJ Bank and Mitsubishi UFJ Trust and Banking for transactions involving strategic shares. Philly, Philadelphia Insurance Companies, is a Tokio Marine subsidiary, a U.S. insurer specializing in niche commercial and specialty lines, including collector vehicle coverage. This time, Philly acquired Ignite Insurance's U.S. collector vehicle, CV insurance business, a niche segment focused on specialty and classic cars with strong profitability. The acquisition adds a high-quality customer base and market-leading position, expanding portfolio and leveraging Ignite's expertise to support future profit growth. Tokio Marine is on track to achieve zero business-related equities by FY2029. For FY2025, the planned sale amount has been revised upward by 60 billion yen to 660 billion yen, due to improved agreements with counterparties and rising stock prices, allowing for greater divestment. This highlights significant progress in reducing equity risk and strengthening financial soundness. Net incurred natural catastrophe losses in the second quarter were 94.7 billion yen, which is nearly 20 billion yen lower than the prior year. Despite this improvement, the full-year natural catastrophe loss budget remains unchanged at 199 billion yen, reflecting a conservative assumption. Stock price. This chart over the past year shows the stock price in Japanese yen at 5,350 as of November 20. This chart shows the stock price in US dollars at 33.45 as of November 19. Tokio Marine announced a downward revision and its share price fell nearly 8% after the earnings announcement. Current PBR is 2.03 and PER is 11.2. Dividend yield is 3.94%. Compared with the past few years, the current price is still expensive in terms of PBR. However, it is more reasonable in terms of PER and dividend yield, although this is partly thanks to gains from the sale of policy stock holdings. Earnings have been increasing and dividend amounts have been rising. Conclusion. The stock price dropped sharply after the earnings announcement, partly due to the downward revision of the forecast. While profits could be lower than they are now, once gains from the sale of strategic shares disappear, dividends are expected to remain unchanged since a progressive dividend policy has been declared. Tokio Marine's performance across both domestic and international operations was largely as expected, with no major surprises. Overall, although the forecast was revised downward, Tokio Marine is on track to maintain strong shareholder returns and strengthen its financial soundness.